Well, futures right below the flat line here. You've got the Dow futures looking like it's set to open off just around 100 points. The S&P 500 coming off its biggest one-day gain that we've seen since 2022. And this comes just days after the index had its biggest one-day plunge in nearly 2 years on Monday. Following jobless claims triggering a relief rally yesterday, helping to easing some fears surrounding a recession. So here with more, we want to bring in Darrell Cronk. He is Wells Fargo's Chief Investment Officer for Wealth and Investment Management. Darrell, it's great to have you here on set. So it certainly has been a wild ride, to say the least, for the markets this week. Where are we in all of this?
So fortunately, we're kind of back in this soft landing camp, right? I mean, I think if you look at key threshold levels, I call it the 3, 4, 5, right? You need to be below 3.5% on the 10-year Treasury. You need to basically be above 400 basis points on high yield spreads, and you need to be below 5,000 on the S&P before you have kind of a problem with hard landing data throwing it in there. It has been crazy though. The VIX on Monday had the single biggest spike it's ever seen intraday in its history, followed by the biggest drop on Tuesday since 1990. So I think investors are a little bit on a hairpin. Yesterday's jobless claims number, which is usually a muted point, shows we got a 680 point Dow rally off of weekly jobless claims, which candidly came in 7,000 less than expectation. The expectation was 240, it came in at 233. That should have been a non-event, and everybody said, oh, now we're back in the soft landing camp. It was a little bit crazy, right? I mean, the investors are on a hairpin right here.
On a hairpin, but it still seems like they're identifying where there might be buying opportunities, as referenced or as evidenced through our conversation with the Robinhood CEO, Vlad Tenev, who said on their platform, they saw some very strategic positions being entered into by their traders right now. So on a hairpin, but it seems like there's some opportunistic buying right now.
I think that's right, Brad. And in fact, we moved a bunch of capital around earlier this week. We actually added back to, we had been underweight small caps for the better part of 2 years because large has just continued to outperform small by a huge margin. We brought that back up because we thought the Russell 2000 came down to a level that was, more or less a fair risk reward trade again. It wasn't off of the July big rally when it was all PE expansion. We also added some money back to high yield because high yield spreads went up to 380 basis points. That's the high point of the year, right? The widest spreads, which means the cheapest entry opportunity of the year. So we took that as an opportunity to do that. We also just think that investors need to get out on the curve a little bit from a duration standpoint on fixed income. They've been crowded, as everybody knows, to the short side of the curve, highest yields on the board. Everybody just wants to roll one-year Treasury bills. And if the Fed's truly going to lower interest rates as much as people say they're going to, right, and we think they will, you can't live there with that reinvestment risk on the short side of the curve. You need to get out and lock in some of these longer term rates.
Darrell, how dependent is all this on the Fed cutting in September? And how much does it really matter if they cut by 25 versus 50, which obviously has been gaining a little bit more popularity?
Well, I think the 50 needs to be the base case at this point. I said to...
Why is that?
Because I think they're actually behind the curve a little bit here. I think they do need to play catch up with the lag effect of monetary policy. I mean, earlier this week, we were pricing in the Fed funds futures were pricing in 140 basis points of Fed rate cuts this year. That's 5 to 6 rate cuts this year, which would mean 50 in September, 50 in November, and at least 25 in December, right? That's too aggressive. That's a hard landing scenario. But I was telling my team earlier this week, when I wake up in the morning this past week, the two things I get my eyes on, very first, the yen, right? Obviously with what happened, and the 2-year Treasury. Because the 2-year Treasury is the only Fed speaker that matters, Sienna. It's not Chair Powell, it's not the presidents and the governors. What the 2-year Treasury tells you is where Fed funds need to be.
And so with that in mind, and you mentioned some of the positions that you were kind of nibbling at earlier on this week and reallocating towards a little bit more. Where does that set up for the rest of the year here as we're kind of thinking about, okay, we're wrapping up this second quarter earnings season, and then eventually once we get into the late throes of September, early throes of October, we'll start to get some of the consumer names that are going to report earnings to end out this earnings season, and then we get into the refreshed earnings season. What is the consumer going to spell out about the economy that will also govern where this market moves?
So it's the great question, Brad, because the consumer is the linchpin here to whether we soft land, hard land, no land, whatever scenario you want to say. Good news, bad news. Good news is, Q2 earnings season's winding down, revenue's growing 5%, earnings growing about 11%. That's the best earnings season we've had since Q3 of 21. That's a great earnings season. We'll take it, right? Because all we've gotten is PE expansion. On the consumer side specifically, though, not such good news, right? I mean, if you look at companies that reported in the autos section, the retailer section, certainly the airlines, which we know, right? All of them disappointed, all of them more or less lowered guidance into the back half of the year. So I do think it's going to be a choppy back half of the year. It's very unusual when you get a market correction with poor seasonality, which we're heading into, to put your lows in August, right? They almost always come in September, October on that seasonality element. So I'd be surprised if what we just put in this past week in, let's call it early August, are your final durable lows. I think you've got to test and retest and consolidate here for a while, and probably mean some more downside.
Interesting. Darrell Cronk, who is the Wells Fargo Chief Investment Officer for Wealth Investment Management, joining us here in studio. Thanks so much. Joining us here on a Friday. I mean, not a lot of people still making their way into office on a Friday. You came to a different office on a Friday.
I love to come in on Fridays. The quietest day of the week.
It is.